Hello YouTube, what is up? My name is Reese, and today I will be talking about some of the key differences between investing in a total market fund or an S&P 500 index fund, and which one might be better and why. And I'm gonna try to keep this video short and concise and get to the point. So essentially, what is the S&P 500? Well, for those who don't know, the S&P 500 is simply it's a market index that is meant to track the large cap market of large US based companies, and it is a compilation of the 500 largest publicly traded companies in the US, and it's basically meant to give an approximation of the overall US stock market health. Now, this is a market weighted fund, meaning the larger the company, the larger the market cap, and then therefore it's going to have a larger weight in the S&P 500, meaning it's going to be top heavy. So you think about Apple, Google, companies like that are really going to be carrying the S&P 500 up or down because they're going to have a larger weight. And overall, the S&P 500 covers about 80% of the overall US market cap. On the other hand, stocks like VTI, which is the Vanguard Total Market, tracks an index which is basically similar to the S&P 500. It is going to be market weighted, but it's basically targeted to encompass the entire 100% of the overall market. So for example, VTI has 4,056 stocks in it compared to S&P 500's 500 companies. So the difference there is using Morningstar.com, which allows you to break down the portfolio. The S&P 500 is primarily going to be large companies with 15% mid-cap stocks in that portfolio, and there is no small cap. On the other hand, the Vanguard Total Market, which is still market cap weighted, we are now seeing a 9% exposure to small cap and a 19% exposure to mid cap. So that is going to encompass a little bit, basically the entire overall market. So instead of buying just the top 500 companies, you are buying everything. Now, that could be good or bad depending on how you view it. So essentially what this means is the total market is going to be a better representation of the US economy as a whole because it's going to track the entire US stock market rather than 80%. And when we compare the largest holdings between the S&P 500 and a total market fund, you will find that they are the same because the largest companies in the S&P 500, which have the largest market cap, are still going to be the largest companies in the overall market. Now, with that being said, I'm going to talk about the key differences between the two when it comes to investing in them. So using portfolio backtest, this is a hypothetical scenario where you contributed $10,000 in a lump sum, never contributed any more, and the two funds that we will deposit using is an S&P 500 index fund and then VTI, which is a total market fund. Now, this is just, like I said, one-time contribution just to see how it does. And over time, the total market has outperformed the S&P 500. And the reason for that is historically small and mid-cap companies have experienced periods where they have outperformed the overall market. Specifically, there's a period around the financial crisis in 2008 where small and mid-cap companies really kind of carried their weight a little bit more than usual and had better returns than the large cap companies in the S&P 500. So if you were invested in these two portfolios, you would have had a slightly higher balance in the overall market. You would have had a slightly better best year and a slightly better worst year. And overall, it has outperformed in the long run. And dividend-wise, they are roughly comparable. It kind of alternates. Sometimes, historically, the total market has, for the most part, paid very marginally higher dividends, but nothing to be crazy. And so what I'm getting at is investing in the VTI or total market fund can really give you that exposure to small and mid-cap companies to help diversify your portfolio, and hopefully, ideally, it might give you a better chance for beating the S&P 500. Now it's time to talk about what index funds are actually investable in and what I would recommend out of the S&P 500 index funds or total market. So to do this, I used two tools, ETF.com, which is nice because you can sort by, you can go through and you basically can go through tons of ETF sectors, dividend stocks, overseas, crypto. There's ETFs for pretty much everything, and you can go through it and you can sort it by assets under management to see what the most popular ones are. And as of right now, the most popular total market fund is VTI. And what's nice is it has a 0.03% expense ratio. Now, similar to VTI, the index funds that I would recommend I'm going to compare it to is, let me find here, ITOT, which is an iShares S&P Total U.S. Market Index Fund, and then SCHB, which is a Schwab U.S. Broad Market ETF, also has a 0.03. So SCHB, VTI, and ITOT. And I graphed them all over and compared each other to one another with TradingView. And as you can see, all three of the index funds basically perform the same because they are essentially the same. They're tracking a total market of the U.S. total stock market. So investing in any of these three funds, realistically, you're in a good spot. However, I still would recommend VTI over the other funds because it has greater assets under management, meaning it's going to be higher liquidity and it's going to be easier to get in and out of the fund. Moving on to the S&P 500 index, I used etfdb.com and ETF database. And what is nice about here is that you can basically go through indexes and select indexes that you like, whether it's like S&P 400, S&P 600, value funds. You can kind of go through and find what you like and see what kind of index funds are available for you to trade based on what you are looking for. And so going in here, the most popular S&P 500 is SPY, IVV, VOO, and SPLG. With that being said, SPY is a little bit more geared towards potentially day traders or swing traders because it has a higher volume, but it also has a higher expense ratio. Looking into, let me see, overview, you can see there's quite a bit higher volume in SPY, but overall total assets, it really isn't that much more than IVV or VOO. So similar to what I did for the total market, I overlaid some of the most popular S&P 500 index funds, and as you can see, as expected, if they are doing the job properly and tracking the S&P 500, they should all perform the same in the long run. And going into another idea was what's nice about, now I'm going to give you a third option. If you're only investing in the S&P 500 total market, another option you have is creating your own blended fund. What I mean by that is, so we know total market is all U.S. companies, and the S&P 500 is 80% of those companies. So another option you could have if you want to get exposure to small mid-cap companies besides just buying VTI is making your own portfolio to gain exposure to those extended market companies in a percentage allocation that makes sense to you. So for this hypothetical scenario, we're going to do a $10,000 lump sum contribution, no rebalancing. And we're going to doing 70% in an S&P 500 fund, 20% in the S&P 600, which is mid cap, and 10% in the S&P 400, which is small cap. So large cap, mid cap, small cap. And when we compare the three, you'll see that at the end, this is basically performing the same as VTI in the long run. There's periods where, so what's nice about this is if you wanted to get really aggressive in, let's say, these smaller caps, you could find a ratio that works for you and your risk tolerances. Now, keep in mind, I personally believe that VTI, if you're going to only invest in one market index fund, I think VTI is going to be your best bet because it's going to represent the total U.S. market, and it has outperformed the S&P 500 historically in the long run. Even if it's, let's say, let me find the long-term returns. Even if it's only by 0.3%, if you are beating the S&P 500 consistently in the long run, you're in a good spot. So to summarize everything I just said, S&P 500, you're gaining exposure to the 500 largest U.S.-based companies. The total market funds are going to encapsulate both the total market, so the S&P 500, plus all the remaining small and mid-cap companies that weren't included, hence 4,000 stocks that are in the VTI fund. And at the end of the day, it always comes down to your personal tolerances and preferences of what you're trying to do with your portfolio. But I believe that VTI has an edge over the S&P 500 because of that. Now, I will be providing a link to some of the tools that I use, as well as references to the tickers that I believe are comparable to each other. What I mean by that is VTI, and as I showed here, VTI, SCHB, and ITOT are all equivalent to each other, and they have the same expense ratio. However, I still recommend VTI because it has higher volume and higher assets under management. And similarly, I would recommend VOO, if you wanted to do an S&P 500. I'll include all those tickers in the description, and hope you guys found this informative and that it was helpful. So thank you guys for watching. If you have any questions or comments, feel free to leave them below. I'll take a look and see if you have any content suggestions for me to look into for the future. I'd be more than happy to do that as well. If you enjoyed the content, please subscribe. I hope to be putting out more videos like this in the future. Thank you for watching, guys. Hope you guys have a great day.